Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to Venture Stories by Village Global. I'm here today with two very special guests, Parker Thompson and Dustin Dolginow, and we are here today to talk about scout programs. Guys, welcome to the podcast.
Hey, thanks.
Thanks, Erik.
Dustin, why don't you start? What is a scout program?
A scout program is typically programs set up by a venture fund to source deals. In doing that, they employ kind of friends of the family or friends of their network to go out and do the sourcing, and they let them take some of the fund's capital to invest. And I think over time, they've started to do more work in terms of connecting these folks and doing some education. And, you know, we've seen progressions along those lines. But yeah, I think Sequoia was the first one to do it. And I believe it was back in kind of 2009 or 10 or something like that, according to Rolf's Wall Street Journal expose about it.
Why don't you both give some context for scout programs? Why did they come into place? What are some of the sort of philosophical underpinnings underlying them, and how has the idea evolved over the last decade?
Yeah, I mean, I think at this point, there's various goals for these scout programs. So as Sequoia started their program, I won't speculate as to their motivations, but I think when you talk more generally around what these firms are trying to do, they're typically Series A funds, and they're typically trying to build relationships, understand the market, and potentially get deal flow, although I think that one is probably overrated or overemphasized relative to just broadly understanding the market and building relationships with the people that are their scouts and are typically or often their founders even. So I think the idea there is, hey, let's spend a little bit of money from our broader fund to build this goodwill, build these relationships, learn these things about the world that we wouldn't otherwise learn as a loss leader for our main vehicle. I think that's an important aspect of it, right? Like, these programs aren't necessarily intended to make money themselves. Hopefully they don't lose money, but they're intended to be, part of this broader strategy of a larger fund.
Yeah, I think that's right.
It's interesting you mentioned loss leader. Talk about a little bit how that concept has evolved over time, because maybe Sequoia was surprised to find out that some of their scouts invested in Uber and
yeah. If you wanted to, it's worth saying that, like, if you wanted to ask the question, do these things work in terms of returns? Uber's the obvious example, right? A Sequoia scout put a little bit of money into Uber, and they obviously didn't do the Series A. So that's somewhat of a damning indictment of these programs in terms of generating deal flow, if the goal is to capture the outliers. So I'm sorry, I completely lost the question thinking about missing Uber.
I think that's a Stripe and Thumbtack. I'm not sure how much of that was related to Jason Calacanis or
Oh, yeah, you would ask about how these things evolved. Well, I think they've evolved. The economics have evolved. So I think the economics have generally gotten better as more firms are doing this. And my understanding is that the initial Sequoia model, you had this little scout fund, but actually there were other people investing out of the same fund, and you didn't know who they were. So it was an okay deal, but it wasn't a great deal. And on the other end of the spectrum, you have folks with 100% carry, and you've got your own dedicated fund, and they're much larger. So I think people who are doing this are trying to experiment and trying to figure out the best way to do it. And because it's a loss leader, and because it's somewhat new, there's not one way of doing it.
Yeah. So if Sequoia was era 1, is era 2 AngelList? What's the evolution there?
Yeah, I can speak to AngelList, and maybe Dustin can speak a little bit to, Maiden Lane and the work that he's done. People often confuse AngelList with a scout program because these aren't normal, boring, old funds. But I think, as we talked about, these scout programs are funded by people who aren't necessarily trying to make money off of them. And AngelList is very different than that, right? Like, the investments are deal by deal. The quality is very high. You can't do any deal that you want, right? You're raising capital on the platform from LPs. And so I think people are very much trying to make money, and it's just an alternative venture model as opposed to a scout model. So it's not angel, It's not scouts, it's not VC, it's this other thing in the ecosystem that enables people like Dustin or myself or you prior to Village to go out there and raise capital for deals where you have access. So it's taking advantage of that access that you might have and to some extent your judgment and putting LP capital that wouldn't otherwise be able to get into those deals in. So the AngelList belief, our belief is that, we can generate venture scale returns here. And if we're not doing that, we should just shut down and go home. So I bristle at the idea that, we would be compared to a scout program, but no, I understand.
Yeah, I think what AngelList's ultimate goal is to build a marketplace or to move the marketplace online, which, makes it incredibly ambitious and special in that regard. And, I had raised a fund in 2013 called Maiden Lane alongside my partner Jeff and alongside Naval. That was called Maiden Lane, where the AngelList offices were at the time. And that was the first fund to bring institutional capital to the platform. And, as we started investing, we were blown away really by the number of people who had incredible access, the quality investments that they were bringing to the platform. And, it quickly, I think, got bigger than we ever imagined it could be. And has continued to grow since then. Along the way, we started experimenting with different structures. As Parker mentioned, much of the deal flow is done on a deal-by-deal basis through what's called an SPV, a special purpose vehicle. We also started tinkering with what we called angel funds, which basically said this angel investor takes this amount of money from these people and has the right to invest it. In most cases, they were part-time, like many of their scout peers. But what made it different is they weren't captive to one fund. Maiden Lane itself did have money from Accomplice, but the vast majority of it was institutional LPs. And we let them raise money from whoever they wanted. So it was more collaborative. And in some ways, I would say it felt a little bit more professional because we certainly didn't and don't look at it as a loss leader. We took it, and the Angels took it very seriously. And I think their performance to date reflects that. And so, yeah, there's a lot of misunderstanding and I think a little bit of FUD in the market, but I think what's happening is the market's evolving and innovating, for lack of a better word, relatively quickly as people realize that, as Parker said, there's so much value in extending a firm's knowledge base beyond the four walls of the office and the brains of the people who kind of have voting power on that fund. Because if you think about it, there's a ton of stuff going on in tech, and those partners' coverage can only extend whatever number the people are. That it's usually a pretty small number, say 5 on average per fund, times however many hours they can work in a day. And if you think about all the stuff going on in technology, it's a pretty big task to cover it. And so whether it's scout programs or other types of programs, I think everyone's trying to understand, how can I see more of the market to make smarter decisions? And that's why you're seeing all this tinkering and to some degree an amount of misunderstanding, because as Parker said, no one really knows. There is no playbook, and no one really knows the final answer. And by the way, the final answer varies by the type of fund you run, maybe even by where you are in the world and so many other factors. So I think it's great to see, kind of let a million different things bloom and let's see what works.
Yeah, and maybe just to add a little bit to that, I think there is a reasonably set playbook for sort of the traditional VC, right? Series A, B, C. You've seen some changes at the later stage into the market with SoftBank and whatnot. This is all the early stage of the market, right? Which really didn't exist 15 years ago at all. So seed is becoming more mature. Those funds are starting to look a little bit more like what Series A used to be, but we're all playing in this market that's new the way that maybe venture was, 50 years ago, let's say.
Could you imagine something like later stage scouts, or at that point, does it just become like a venture partner or just a different thing?
I mean, yeah, my opinion is the market is very efficient. I mean, you do have people raising SPVs to put into these later stage vehicles, and they're basically saying, or these later stage rounds, and they're basically saying, hey, I can help you go to China or do X or do Y, right? Like they come in and say, give me, an allocation of $10 million. I'll go to Abu Dhabi. I'll get $10 million. I'll put it in. My compensation is carry, and I'll help you with this thing that I can do. So you see that? That's not so much scouts, right? And I think that's always existed to some extent. I mean, if we're defining scouts as, hey, this is an initiative I engage in to help my core business, that doesn't make as much sense later stage. You do have in the market things like the Andreessen partner model, where they have board partner model, where they have folks who aren't necessarily investing partners on the team, but take board seats for them. That's not really anything to do with scouts, right? But that's a way that they've scaled their ability to invest in these Series A companies while maintaining a smaller set of core investment partners.
Yeah, I think it's an interesting model, but I want to double click on a few things we spoke about. So one is, I think one of the innovations that AngelList / Maiden Lane has brought, and that we've tried to build upon, is that the Scout program or the idea of Scouts is not just a way to extend the firm's resources and getting information, but can also be itself a strong investment vehicle, as shown via the early Sequoia Scout results. Dustin, would you say that's accurate?
Yeah, I mean, Sequoia's Scout program has outperformed a majority of funds out there. I think even when you remove Uber, from folks I've spoken to, it seems like they've also actually generated deal flow at the Series A level, and those companies are doing quite well. So, yeah, I don't think of it as a loss leader. I doubt the firms do. I think that is how a lot of people look at it, partly because these people are part-time, partly because it's a small amount of capital, and typically the firms that have done it, have done so well. I think they just kind of see it as play money. But I don't think there's one way of looking at it. I think at Maiden Lane, we didn't set out to create a Scout program. That when we pitched it to LPs, that those words weren't even in our slides. What we said is at early stage, there's more than one approach to building a business, and there's a lot of people out there who see the market beyond just seed funds. And so I think that's where the marketplace kind of started. And then obviously, as Parker can attest, now it covers multiple stages, multiple geographies. I mean, as you do when you build an online marketplaces, it grows and grows and grows and has more coverage because of the laws of software. And so I agree. I think inside of it, there's a want and desire for ways to think outside of a 2 and 20 fund, because of the nature of a 2 and 20 fund, because of the business model of a 2 and 20 fund, and frankly, how there's really only one or two kind of proven ways to make money inside of that type of vehicle. And and then I think a lot of people feel like those constraints feel not artificial, but somewhat misaligned with very early stage investing. And so I think that's where a lot of this innovation is focused, and for good reason. Running a very, very small fund is uneconomical for everyone involved.
Yeah, I mean, it's worth saying that, the reason you're seeing all this innovation at the earlier stages relative to the later stages is it's super inefficient and relatively young, right?
Yeah.
So you're going to find innovation where the market is super inefficient, and relatively less where the market is mature and efficient already, right? So, Dustin and I are both thinking all day long about seed, because that's where the action is. And that's also why you're seeing all this sort of experimentation with different Scout models, because we're all just trying to figure out. And maybe it's possible that 10 years from now, the market will be very efficient and boring, and there'll be some other place for experimenting, but this is where the action is now.
What was interesting about this is it sort of challenges a couple assumptions people have about VC, which is one, that you need to be full-time to be, or early stage VC, you need to be full-time to be good at it. And two is, and this, more threatening to early stage VCs maybe, is that you need to have experience investing in order to, determine who's going to be the next great early stage investment.
Well, I mean, the question is, how do you define good, right? Like what are the predictors of success at these various stages? And I think when you look at sort of post product market fit, which is kind of where I see Series A today, and to some extent some of these bigger seed funds, often the problem is, how do I win the deal? That's sort of as the primary problem. And then, how are you building network? How are you picking deals? Those things matter, right? But they matter relatively less once the market is proven out and there's some data there. I think at the seed stage, pre-product market fit, it's super inefficient because those folks who have bigger funds can't scale down. So there's a lot of opening for folks who don't have big funds to do it. And then you're trying to evaluate people. Everything looks awful. So founders are taking 200 meetings. Networks probably matter relatively more, right? You're like, okay, I know smart people who are working in a space that matters. Let's give them some money. So I think the difference in how these markets operate really leads to this idea that someone with a good network with no investing experience could be better at seed relative to how they might perform at A, where you actually want somebody full time. You want somebody who can write a giant check. They can sit on your board and all the sorts of things that matter there that don't matter at seed. These are the reasons why you see, maybe some angels having phenomenal portfolios doing this part-time, or scouts doing well.
Yeah. Earlier you mentioned, Parker, that you don't want to speculate on behalf of the motives of Sequoia when they first started. I'm happy to speculate because we all learn so much from them. I think one is sort of have your cake and eat it too, in terms of how do you get extra deal flow, extra sort of information without, big concern at the time, and maybe still today for some firms, is without signaling risk. So the idea that, if Sequoia invests at the seed but doesn't at the A, is that a bad sign for the entrepreneur or in market when they're raising? So Scout allowed them to not have Sequoia on the cap table, but still give Sequoia access. And then also it allowed Sequoia to basically have a sort of a wide portfolio in practice, but a smaller portfolio in terms of, the companies listed on their website, so they could still have great statistics and be known as a very selective firm for their Series A.
Yeah, I mean, I guess the reason I don't find that compelling is on the information side, you spend your time where you spend your money, and that's why they didn't get Uber, right? They had this teeny little check in it. And I think when you look at how you generate returns from a venture fund, it really is a function of how much of your capital you're putting into these deals, right? So it's like you put X% of capital from a deal or from your fund into a deal. If that's, 5% of your fund, you need 20x to return the fund. And that's really the mindset of these funds, for good reason, right? That model works. And so I don't think that there's a model where the small percent that you're deploying into these scout funds is ever going to be a material return for you. I don't know. We could ask some folks at Sequoia and really see how they've done. I think to Dustin's point, they're not necessarily losing money, and that's great. But if you're getting a 3x return on 1% of your capital, you've returned 3% of your fund with this initiative. Like, you've got to justify the time that you're putting into this initiative some other way, because it isn't financial returns that's going to get you.
So I agree with that. However, they did just raise a $180 million seed fund, which I believe.
Yeah, that's a dedicated seed fund, and it's probably worth distinguishing between that, right? There's a reason why a dedicated seed fund is not competitive with a scout fund, right? Like, we're trying to make money with a seed fund. We're maybe trying to do something else with a scout fund. So, I mean, I think the fact that they've raised a seed fund is pretty interesting and worth sort of having a broader discussion about, right? Like, how do you think about multi-stage strategies within these larger firms? But I think that's distinct. I'd sort of associate their scout program much more with their Series A efforts than I would with the seed fund. It'd be interesting to see how they kind of structure those teams and work together there.
When everyone thinks about scout programs, because Sequoia launched it, they look to Sequoia. And when I think about how their scout program's designed, how they ran it, how it works, to me, it's a great solution to the problem they're solving. I don't think Sequoia has any issue with access. I think they can probably win about any deal that they want. I think they're focused on saying, look, we know we have access to almost anything. How do we maximize our opportunity set? And if you think about entrusting some of the most ambitious and successful people in your network with a small amount of capital, and then using their decision to make an investment in that person or in that company as part of your process, I think their scout programs, like, one of the most masterful and brilliant moves that I've seen someone do in venture. And it's what makes Sequoia special. And when I talk to people about scout programs, I tell them, you should probably stop copying Sequoia, because we're not in the position that Sequoia is in, and our problem set is different, right? And like, when we set out to do Maiden Lane, it wasn't meant to be a scout program. We were actually trying to, generate returns on those deals by themselves, because we needed those returns. And I think that's also driving a lot of this innovation, is people are figuring out, they're like, well, like Parker said, we have this tiny check into this company. The information we got is actually not that useful. The scout doesn't even really care. They have a full-time job, oftentimes running a startup. So, like, what are we getting out of this? And I hear this from GPs time and time again. It's like, well, yeah, you copied Sequoia's program, which in my opinion, was meant to just light up a board and to say, hey, we see 1,000 opportunities. Which 100 should we pay special attention to? And if the original scouts like Drew Houston and Elad Gil, if they say, look, I think this entrepreneur is special, you better damn well believe they're going to give more attention to that opportunity and still miss some, as they did with Uber. But, when you look at the pipeline and the data, like that program has outperformed on every measure, not just, I think, in delivering in their strategic objectives, financially as well. It's crushed it. And I think that's also why a lot of people have run into the market, because they're realizing that there's multiple layers of advantage if you run this right. But, I don't think it's a good idea to just copy what they did. I think you have to think about what you're doing as your fund, and each fund is going to have a different kind of problem set to solve.
Yeah, I got my start into angel investing after quickly, running out of my own money via scout investing over with a couple of firms over a multi-year period. One was Index, which was led by Terrence Rohan, who's now starting a scout fund called Otherwise, who I also consider, like you guys, sort of a pioneer in this. And they did an amazing job with community as well as social capital, who's also run by Arjun Sethi, who also did a great job with community and scout selection. And I think the difference of doing scout program at big funds like Index and Social Capital is a fewfold. And there's one is obviously they can do it as a loss leader. And what we try to do with Village Global is create sort of an independent, network-based fund that Scout wasn't this loss leader to something else, but it was sort of the main thing. And the few lessons we learned or wanted to do different was, one, we want our quote unquote scouts, we call them network leaders, to have skin in the game. So to be making investments alongside us, because you sometimes run into the free rider problem of, free money, I'll do as many as possible. Two, we wanted the scouts, when they made an investment, to also be able to pitch the Village platform. When scouts were pitching, Sequoia scouts were pitching entrepreneurs, I don't think they were saying, and you also get access to Alfred Lin and all this, amazing Sequoia partnerships. And then three, also just focus and giving resources to help the scouts and network leaders get better as investors or get leverage to a network beyond them. I'm curious with that, what are some lessons, perhaps, Dustin, you learned from your Maiden Lane experience in Fund 1 that you guys applied to future funds and that you'll apply in the future?
Yeah, I think the biggest lesson was we came in with, I think, a view of exclusivity around who had access. And we quickly learned that a lot of people have access, and they may not be as branded or kind of like as well known through social media or blogging, but we were really, really impressed just at how many people, through just sheer will and hard work, had good access, who also referenced really well with founders. And, over time, we also saw those people start to just make better decisions about both kind of the companies that they're investing in, starting to understand how to negotiate and fight for better terms and things like that. So I think, from 2014 to 2016, it was just like this whirlwind of acceleration. I would say the other thing we learned is you can head out with the best of intentions around saying, okay, I want to get, this kind of deal flow, you define whatever it is. And in the reality, no one has like a specific kind of deal flow. They have a network, and from that network, which is heterogeneous, you get heterogeneous deal flow. And so I think it can be hard to craft like a strategy specifically around a person, because you're sort of misaligned, where it's like, well, I just want your very best, first check deal flow, like where you're within the first 100K of investors into the company. And when you look at it, most people don't have, 10 or 15 of the great opportunities like that in a year. They may have 10 or 15 really interesting opportunities. Some will be a little bit earlier, some will be a little bit later. Some might not be in the United States. And so I think that was part of like the struggle at Maiden Lane, was to be like, okay, we have an incredible amount of access. We're seeing amazing deals. How do we refine that into a business model and take a step forward, as a platform? And I think, Jeff and Naval have done a great job in taking a step forward with Spearhead and making decisioning cleaner and clearer, and, moving more towards a person-based model. And it looks a lot more like a scout program for sure. But inside of that, I think, we learned that, the person closest to the company needs to have decision-making power, at least very early on. I think that was one of the struggles we had, with Maiden Lane on AngelList, was oftentimes, we would have these angel investors slamming their fists on the table to be like, we have to do this investment. And it was just hard for us having never met the team and, having never dug into it to really kind of get excited about it and see it. And so I think that was, a big driver behind thinking through, wow, okay, how are decisions made? And they should probably be made differently depending on the stage. So the earlier you go, it's more of a conviction-based decision-making process because, like Parker said, every investment looks terrible at that point just because there's no traction, there's no business metrics to really tie to. And so, I think what we're all seeing before our eyes is basically the redistribution of decision making within venture, and people are starting to realize like, hey, maybe we shouldn't have a consensus-based decision making process, without kind of like real data to anchor to, which typically means post product market fit. And so, what would replace that? And I think that will be the lasting impact behind Maiden Lane and Spearhead to some degree is this idea that conviction-based decision-making, within certain parameters actually is a better quote unquote product for, the first maybe up to $1 million raised. And you can do a lot of work on the people making those investments to understand if they have the right access and judgment, and skills to make a good investment. And, you can kind of put some rules in place to avoid a lot of the gotchas of areas you actually don't want to invest and keep people away from kind of investing or being guilted to invest in their friends and things like that.
One thing we think a lot about, a couple things. One is what makes a great scout, but two, or a great person for this type of role. But two, even broader is if you're creating a portfolio to these types of investors, you need to think about a few different ways. Different archetypes. You can make it all founders in the way that Spearhead has. You can make it sort of operators at connected companies, like someone like Neve at Product Hunt. You can make it domain experts. People who are super green, super new. People who are experienced angel investors or former VCs. How did you guys at the time think about archetypes for what makes a great scout, and how do you create a portfolio?
I mean, I think it depends on your goals. If your goal is
returns.
If your goal is, for example, to build network and you're not trying to make money directly on the capital, then you just want to find people with great networks who you really admire. And so it's smart to just say, hey, let's go to our portfolio and find these phenomenal founders because other founders are going to find them. I think the challenge that folks like you at Village have, right? Or you guys are trying to make money on your fund, and so are we at AngelList. And, good picking in that regard is I want something that actually has like a higher probability of failure than I might by default be comfortable with. I think that's generally a challenge in learning how to be a good investor. You're like, actually, like I'm pretty happy with something with a 5% of being 100x if I can pick, 20 or 30 of those, right? And that's just super unnatural to sort of operate in that mode. So I think getting alignment between the goals of the fund and the goals of the person who's making the decision and deploying the capital is really important there. And so, I'm sure you guys will see in your portfolio that there are people who are really good at picking 3x companies, and that's just really bad for your fund, right? So you're like, hey, you made a lot of money. That would have been a good venture return if that were our entire portfolio, but we're investing really early. Our failure rates are really high. And so we need to actively seek out higher risk, higher ceiling deals. And so that's how we think about it, for example, at AngelList, because we're trying to make money, right? It's like we're okay with fairly high failure rates across a portfolio. We're looking for stuff with really high upside. And because it's deal by deal, LPs can seek out those deals. And in fact, there is a sort of a constituency of LPs who like to go later stage or like things that are a little bit less risk reward oriented towards early stage VC. So I think you've just got to really align the people making the decisions and the capital so that you end up with everybody happy at the end.
Yeah, I think this idea, it's the right way to think about it is what is the right archetype? And I think Parker nailed it in watching all the angels that we did on AngelList. Maiden Lane in our first fund, we worked with 150 angel investors, meaning we gave them capital. And it is so rare to find someone who is truly risk seeking and who understands that, we're going out and trying to source something that is 100 to 1,000x. And it's really difficult to see that this early on. And, a lot of what you're doing is sort of getting out of your own way and also making sure that you're investing in the right markets that can scale to that ceiling. And I think as the market around scout funds matures, we're going to see just how rare it is to be able to grab someone, because most people who take this money initially are happy to, fast follow into a few, seed deals that are relatively late, and, they feel good about the social proof around it, but are oftentimes not doing what by all measures they should be doing, which is championing something that the market doesn't quite understand yet, and helping, that founder and that company get through the trough of sorrow, into the spot of the market that everyone kind of missed, right? And so I think you can talk about archetypes of domain experts and all the different kinds, but I think as the market evolves, based on everything we've seen, there's just not that many of these people who are truly risk-seeking, and you'll eventually see people start to set aside what feels comfortable, meaning, oh, okay, we back this person in our portfolio, we like them. I know that makes you feel great. That has nothing to do with whether or not that person is really risk-seeking and going out and doing this work, or even has the time to do it. I think you're going to see groups of people who want to double down on this start to, really look at psychological profiles and personality traits, and like, what has this person done in their life to truly be risk-seeking? Since stepping back from Maiden Lane and Accomplice, I think that's where I've been spending a lot of my time, is trying to understand, how do you spot these folks? Because it is that rare. But I think when you can, bring a group of those people together and they can invest early enough, there is a business to be built there. And I think it is the most innovative and exciting part of the market for that reason, because it's so strategic. Those people are at the very top of the funnel, right? They're there kind of when no one else is believing, and that has a lot of downstream value, and also happens to be a great business from a returns point of view.
One big question is, how much money can scouts deploy? One is, how big of a check do we feel comfortable letting these scouts write? And then two is, like, how much can the scale? How big can the fund be? And this is, of course, assuming that it's an independent scout fund trying to make, optimize for returns. Have you thought about that?
Yeah, I think it depends on a bunch of things. But let's say Village. Let's look at Village, because that's interesting, right? You guys have this fund that's on the order of $50 million. How big is it now? 100? Yeah, congratulations, mazel tov, So you got $100 million, and you got to deploy it through these scouts. I think the bigger your check size is, that sort of naturally you move downstream in the market, right? So if I've got, a couple $1 million fund, it's pretty easy for me to write day one checks and to write a 25K check, right? If that's what's left in a round. I have a lot of flexibility. I can play really early, and that's going to be rational for me. I have some other, advantages, right? I don't need as big a returns to get my capital back, all these sorts of things. So if you got $100 million, how many deals are you guys planning to do from the fund?
So around 150.
Okay. Yeah.
So, basically right now we're exploring this model where, because we don't, trust our scouts to write, $500K checks or $1 million checks, et cetera.
Yeah, exactly. Yeah.
There's going to be a bunch of 100K checks, and then there's going to be a subset of those checks by which we, the team, are really excited about it and double down at that same, time for 500K on top.
Yeah, cool. Yeah, it's an interesting model. I think, there's this concept of what I would call an and check versus an or check, which is to say, like, if you want to write a 25K check and I like you, you're kind of an and check, right? Like, you can figure out a way to cram that into a pre-seed round, a seed round, maybe even a Series A round, right? Like, it usually works. And then as you scale up the fund, you guys, 150 deals is even a lot of deals, right? It's going to be challenging to manage that with your team and your time and whatnot. So there's a certain point at which you just kind of go like, you know what, like, to make $100 million into $300 million, we need to be writing bigger checks. And, if you're a scout and your whole thing is, hey man, you like me and I know you, let me put a little money in, that's great. But, the folks writing $1 million checks actually then take their management fees and their time and do a bunch of stuff for you. And so if you've got a scout trying to write $1 million check against someone who's a professional VC writing $1 million check, that might be or, right? Like, you've got to take one or the other. And so I think that's where it gets a lot harder, right? As you scale these checks up, and particularly within the context of the round, right? When you want to take, more than, say, 10 or 20% of the round, you really need to come with a different value proposition. And many of the folks, the scout model by default is not designed to do a bunch of stuff for you. So I think there is probably a limit to what you can do there, but there's also ways that you could potentially innovate there as well. So like you could, for example, say like, great, well, the scout will bring the deal and then we'll sell our network, which is what you guys are doing. And I think other people have been doing different stuff with that. At AngelList, our solve for this is to say, look, like I call it the 1099 VC economy, right? Like there's these people out there, they're bringing us allocations and deals. We don't ask what we do talk with them, but like in principle, we're not saying like, hey, how did you get this? What was your value proposition? It's sort of proof by existence, right? If you bring us an allocation in a good round, we're going to be able to put that in front of a marketplace of LPs. And generally speaking, those deals are going to attract capital. So really the people who are successful on AngelList at like small scale are people who are just good at hustling, right? You go out there, you get little allocations. The people who are really successful at scaling their business on top of AngelList, and there are definitely people who effectively run their business on AngelList. It's how they use the platform and they built a business for themselves as, I think of them as VCs, right? It's a little bit different model. Those are folks who have said, hey, I have this conference that I run that's the biggest conference for these sorts of people, and then I can help companies with recruiting, or they've scaled it to an extent where they're like, look, I'm going to help you raise your Series A because I know all of the Series A VCs and this is my track record. So they're going to these people and saying, I can justify a larger allocation because I'm going to do a bunch of stuff for you. And at least traditionally, the way that we've thought about scouts is these are founders of companies who have been successful, so they have good networks and they're very attractive in terms of you want them to be involved in your company, but they're actually busy running their own company, so they're not going to do all of these things that someone who's really trying to be more of a pure, service industry oriented VC is doing. So I think that that's the natural upper bound on this thing is when you start competing against people who are doing this one thing professionally, you have to figure out a way of having a competitive product with them. And that's actually not easy because as much as we like to bag on VCs, a lot of them are pretty good, pretty smart people who can be pretty helpful. So that's a competitive set.
Yeah, I think of it slightly differently in that I think the amount of capital someone can deploy is a function of the markets they're deploying it in, their experience as an investor, and then sort of their available time and energy, to do the work. And I think people who are running companies, especially earlier on in the company's life, are just they should be struggling to have enough time and focus, to be writing larger checks because they have a going concern as their day job. And so those folks seem to be able to write, 50, maybe 100K checks. I think, if someone's more full-time-ish in terms of both their time and focus and they have more experience, they can quickly get up to writing 100 to 250K checks. And then, we've seen on AngelList people who, like Parker said, are running real businesses and moving, in some cases, 7-figure allocations, obviously in later stage rounds and things of that nature, but they're finding a way to be value add and really treating it as a full-time job. I think, and my hope is that, everyone kind of treats the capital with some level of fiduciary responsibility so that, A, we can continue, doing scouts, and B, the returns kind of maintain themselves and people make good decisions. But there isn't one answer. And I think, underlying it, there's also a question of, what you're solving for. Clearly AngelList is solving for creating a marketplace. And so, they want as many different, they want access to as many different great deals as possible. I think if you're a larger fund who's running a scout program, you're like, look, we want access to Series A investments. We don't want people investing beyond seed, or maybe they even want to invest in earlier than that. And so again, there's a lot of different kind of levers to pull and incentives at play. But I think generally the most promising area for scouts that can have an impact, on the scouts themselves, on whoever's providing them capital, and on founders is to be playing in that, zero raise up to 500K and being a champion for, what right now looks like a weird opportunity, right? And that's where we can start to like dislodge some of the ugly sides of consensus-based decision-making, right? Which I think are well talked about at this point. One way to do that is to build a team of folks that are diverse in thought and in preference and go out and kind of champion these opportunities. And, I think if the ecosystem continues to put those people into the market, it's not only going to perform financially, but also hopefully help some of the better founders rise up, even though they may be overlooked initially.
Yeah, I mean, I think maybe to put numbers on it, my anecdotal evidence, I haven't actually run the numbers recently, but I think what you see on AngelList is people who are have a more scoutish approach to the market. I mean, it's not scouts, but sort of in the same ballpark, tend to be, let's say, 10% of rounds, maybe a little bit more sometimes, right? Like you might write 100 to 250K check in a round that's, $1 million to $2 million. So you're sort of seeing that at the seed stage. And then at the later stage, you're seeing it sort of bifurcate, where you see some people who are able to do a ton of work for companies and take much bigger rounds, and you're seeing other folks who are really struggling to get any allocation because, there's a Series A fund leading the deal, and then there's a bunch of institutional seed investors who are going to get their pro rata. So you're sort of beyond that in the pecking order. But it's case by case, right? And so the people who are really getting large allocations and being meaningful participants in, seed or Series A rounds are people who are really trying to run more of a professional business, and they just happen to be using AngelList as their back end. And you could sort of think about those people as being a lot more like professional investors than part-time people or scouts or whatever you want to call them.
Yeah, and sometimes those are the perfect people because they treat it very seriously. They spend a lot of time on it, and you're aligned with them, and that you're both optimizing for returns.
Yeah, well, these people we've been talking about from the finance perspective, but if you look at it from the company perspective, all of these people are useful to the company just in different ways at different stages. So, maybe really early, I'd love to have a bunch of 25K checks from a bunch of scouts who are just great founders and can help me and in little ways as I'm trying to figure it out. And then, you see the value in somebody who's going to sit on your board and help you really build the company. And, as the company grows, your needs change. And so, you're going to go to these various kinds of investors and say, hey, here are my problems at this stage. What can you do for me? And, I think, speaking for myself, I think I'm a lot less useful post Series A. I mean, there are some things I can do, but I probably have most of my value early. And so that's where I want to get my allocation and deploy my capital. And then if I can deploy capital later, hey, that's great. But probably there's going to be somebody who only does that, who's going to be better for the company at that stage.
I'm curious if you guys, so let's say you're running a $20 million or $30 million, scout fund or independent scout fund, something along the lines of what Maiden Lane was or Spearhead. How would you think about portfolio construction in terms of at seed and would you do follow on? If so, how would you think about follow on seed portfolio construction?
We had an ongoing debate, and I think it's going to take a while to really see the data play out about portfolio construction. And I think it's one of the most interesting and important debates to have. My sense is I'm sort of, I guess, in your camp as far as Village Global. I think, if you're investing that early and taking a more network-based approach, you're probably going to be, in the 100 range, 100, 150. Maiden Lane was about double that. And I think that was like a little spread for my taste. But, as we look at the portfolio maturing and as companies kind of grow up and start to show some traction, we're learning about the pros and cons of each way of thinking. I guess separate from just the straight portfolio construction as a map to returns, I think portfolio construction as like an indicator of like the type of business that you're running. I also think it's just difficult to manage beyond a certain point, no matter how many resources you have or how much software you have. And so I think, you can do better by founders and actually do better by your LPs by having those relationships, just by keeping it, somewhat smaller. So really just based on observation and gut at this point, until we have data back and can be more scientific about it, I would say, 100 sort of is where my head goes. And so you just back out kind of check size and thereafter. As far as follow-on investments, there's certainly a lot of desire from LPs to want the fund to follow on aggressively in the winners. I guess being realistic and taking a strategy of investing in 100 companies, it's going to be difficult to really follow on aggressively into the winners. And so the way I would think about it is almost bifurcating, let follow on be an SPV and do your best to identify those winners and build a strategy and a business around an SPV approach, so that if some LPs want to back out, they can, but that, you're able to do more than you could within kind of a traditional fund structure. That's how I think about it now. I think, like I said, over time, the data will show us a better path forward.
Yeah, I mean, I personally tend to think there's just a bunch of variables, and you've got to figure out which you want to hold constant, and then how you build a strategy around those variables. So, one that's probably worth starting with is, how are you generating an opportunity set that's interesting? Because you just you can't do more, or you shouldn't do more deals than you have opportunities of things that could be 100 to 1,000x, right, at the stage that we're talking about. So you've got to, I think, start with, well, how many of those opportunities am I going to see? If it's 10, even though 10 is probably theoretically from a math perspective not a good portfolio size, right, you probably want more diversification. You don't want to add 10 more crappy companies, or you're just going to do worse, sort of definitionally, right? So I think what we've been talking about with these various models, whether you're giving people dedicated funds or doing deal by deal or picking people with no experience or founders or professionals, right? These are all questions about how we're going to generate an opportunity set that's compelling. I think assuming that you've got a compelling opportunity set, then to Dustin's point, the question is well, okay, what's our reserve going to be? How are we going to make follow-on decisions? And I think where models like Village are, going to have to work really hard. And we talked about this before you guys raised the fund is, if you don't believe that you can make good follow-on decisions because, for example, you don't meet with the companies, so you don't know the people, then it's irrelevant what the sort of the platonic ideal of a reserve strategy should be. Yours should be zero reserve, because you're just going to deploy the follow-on capital worse than you would the initial capital. And then there's a question of what the market is, right? So, for example, I tend to think that, the risk-adjusted return on sort of the layup round, whatever you want to call it, the seed plus, the bridge, whatever, often these are actually really a lot better than the Series A, just given the Series A market. So, I tend to think that you want to have a portfolio that's sort of in the, let's say if you're going really early, pre-seed, probably 50 plus, and seed probably, you could get by with a few less than that. And then I personally like to get greedy pre-Series A. So I'd prefer to write my follow-on check, if I'm going to write a follow-on check, before the Series A is done, because I think those funds have gotten big enough that it's hard for them to even, get involved pre-product market fit, right? When I call my friends at Series A funds, they're like, hey, this company looks cool, but we can't afford to invest in the one that's not the winner. So we'd rather wait and see who's the unambiguous winner. And it's well, that's great, but I can't afford that because I don't have $1 billion fund. So let me invest at pre-seed or seed. Let me invest if there's a second round at seed or seed plus, and let me write 2 or 3 checks. And I know people who might write 4 checks before the Series A ever happens. I think there are a bunch of variables that you need to understand in the market. And then there's a question of what's your comparative advantage? What do you want to be doing? Where do you want to be playing? And then you build a strategy for that. And so those numbers are probably, somewhere between, 30 companies and 150 companies, depending on, where you kind of land on all those variables.
Yeah, I think the reason why we have follow-on strategies are threefold. One is because it's a lot to ask a scout to do, $500K or $1 million. 2 is because we hope that we can, in terms of how to get data on this company's, thesis or hypothesis yet to be really, tested at scale, is can we leverage the network leader to help us get intel on companies, especially if they're sort of professional investor type who themselves want to be doing follow-on investing. And then 3 is, do we have an advantage over a regular firm in terms of our network, in terms of getting into the best deals? Because some of them at follow-on are more obvious, perhaps than others. And so, as you said earlier, it's an access game, and can we have it?
I mean, I think you guys, my editorial opinion is that you guys have a reasonable approach. You're not saying hey, Scout, go deploy this money, and we're not going to even know the founders of the company. You're getting engaged. You're doing the job of the VC, right? Which is to get in there, understand the company, help the company. And I sort of think about it as the way that you make money in follow-on is having much more longitudinal data than the person pricing the round. Because a lot of these rounds are overpriced, in my opinion, and the ones you want to do are the ones where you're oh my gosh, I'd pay 4x this thing, and the market just doesn't understand how great this thing is, because those Series A folks that are pricing this deal have only met with this company a couple times, and I've been watching them for 2 or 3 years. So I think that's the way that you make your money in follow on. And I think the more deals that you do, the harder it is to get access because you haven't been there, but also the harder it is to have judgment because you don't have data. So I think that's a tension, right? That's a tension as you scale the size of the portfolio, which, if you do the math, it can say like, hey, if we want to maximize our probability of a good venture return, we should just keep doing more companies because the math tells us to. And it's like, well, that's just not the whole story.
Right. There's sort of a broader debate even outside of scout funds of not only portfolio size for diversification, but I think we're all on the higher volume side, although Dustin, feel free to jump in if you're not. But the is just follow on versus seed generally. And the idea is if you are doing that many companies, is it best to put in, let's say not in a scout fund, is it best to put all the money in up front versus follow on? Because if you leave some follow on, the theory is that you're just paying more later, and the new data is already priced in by the market. What do you say to that idea broadly? I
mean, the market is still relatively inefficient, right? So I don't think it is necessarily priced in. I think the question is, where do you think the prices are going to be? And do you think do you think risk is coming out of the business faster than prices are going up, or the other way around, right? And depending on whether it's one or the other, it's more rational to deploy your capital up front than later on. I mean, there are some other reasons, in terms of company alignment and these sorts of things where you might feel better about just putting all your money in up front. But, the question is like, well, are the Series A folks paying 4x what it's worth at Series A because they're actually thinking about a blended cost basis where they're deploying $100 million at the Series B, in which case their strategy is rational for them and it's irrational for me to write a check and around the price? Or do I think actually they're trying to make their money on the A and I have more information, and so I can write that check selectively into the A's that I want to do and make more money than them because I have more information? I mean, you just have to make decisions on what you think reality is and then build a strategy around that. I mean, I can tell you on a personal basis, I'm doing a very small number of deals a year just because I find it hard to find that many great things. But when we look at this at AngelList, we just completely punt on this by building a strategy that says, look, we're going to look at each check in each round completely independent of all the other checks that we've written and make a decision at the time that we see the round based on the data that we have. And I think that gets confused for VC, but when we sort of sit there and make those decisions, that's not what a VC does, right? We're not meeting with the companies. We're looking at a bunch of signals that we think are predictive of outcomes and just trying to build a portfolio of checks that is relatively large. These portfolios are 200 to 300 companies. And when I speak about the AngelList run funds, and we think that can generate a good return, but it's just a strategy that happens to work in the market with our deal flow strategy, as opposed to one that would necessarily apply to Village or someone else.
So for people out there who are listening and are saying, hey, this is all interesting inside VC baseball, but I just want to write checks. How do I become a scout? What advice would we give them? The first thing I would say is, as someone who was a scout is, have a unfair advantage as to why you have a source of deal flow in the first place. Maybe it's because you work at a company like Product Hunt or AngelList or Mattermark or something that sort of sells to other startups or is involved with them, or you have become a domain expert in a specific category, or you're at a company like Stripe or Palantir where all these great companies are coming out of, and you sort of are active in the alumni chapter and are the go-to person for when they leave to start a company. And then is to develop a relationship with a firm or set of firms where you're just regularly passing them companies or offering to diligence certain companies on their behalf. And then, if they have a scout program, asking them if you could be a part of it, or if not, asking if you can help them set it up and you could be the sort of guinea pig for it. What other advice would you add or edit to that?
Yeah, I mean, I think maintain like a super high level of curiosity. And, generally, I think what we have observed over the last few years in working on AngelList is, the people that succeed are highly curious. They're not curious for curiosity's sake. They want to win, so they have a competitive edge. And then I think also just consume as much as you can around try to understand like what risk is, what risks you're taking, and seek out that knowledge, because like Parker said, it's such an unnatural thing to do, to purposely take on a lot of risk. We're not trained in any walk of life to do that on a regular basis. And so I think if you go in with eyes wide open and a high level of curiosity around how to figure that out, it's a big help. And then just continually build your own community of people that you're close with, that you're helpful with, and that turn to you for advice or favors and things like that. And I think you eventually find yourself in a place where people are going to ask you to be a scout, or in addition to taking the path that you suggested, which I think is really smart.
Yeah, I mean, I think what I would add to that is, if you want to be an investor, the best thing you can do is just go out there and find people who you think are working on interesting things and help them. So like, you go and find some company that's getting started that you think has an opportunity to be big, and you just say, hey, look, I think what you're doing is great. Can I help you? And like, sometimes those things turn into advisory relationships. Sometimes they don't. But basically, like, if you go work with a portfolio of companies and just put in some sweat, there are going to be opportunities that come up. And to sort of talk my own book for a second, I always tell people, it's like, AngelList isn't a panacea, right? Particularly when you're getting started. If you have no track record, it's very hard to bring a deal and just say, hey, I've got this startup. I believe in them. They've raised no money. Can I raise money on the platform? The answer is generally no. But a good way to start is to work with that company at that stage, get them to a point where they actually are positioned to raise a good institutional round. And you might not even actually be able to help them with that when you're getting started, but you're helping the company, you're understanding the business, you're providing value to them. There'll be a reference later. Maybe you're meeting some VCs in the process of helping this company grow. And at that point, you can call AngelList and say, hey, I've got an allocation in this company because I've been helpful to them. And you can often raise hundreds of thousands of dollars on the platform from LPs you've never met. And now you're a VC. You've got one deal in your portfolio, and do that again and do that again. And pretty soon you have a track record, and you've built a track record even without having a lot of your own capital. So I think AngelList is very different than a scout program. There's a little bit less autonomy. A lot of people don't make it because they don't put in the work. I mean, it's not easy to get started, but people who are good at it find it to be a really productive platform to use. And, you can make yourself a VC over time. So I'd really encourage people to, get involved with companies. And, if no VC is going to call you, I mean, often they're really looking to get involved with founders of companies. So particularly if you're not a founder of company, you might have to find an alternative route. And my personal opinion is that, just picking founders of companies doesn't necessarily give you the best pool of people who are good at picking companies. So I'd love to see more people really come and, try to make this work on the AngelList platform if they truly are interested in, building a track record.
Totally. I think that's great. I think one other thing I'd say is a couple other benefits I've seen for people who have scout programs. There's sort of unintended or non-obvious benefits. I've seen one firm sort of use it as a sort of potential GP training or like vetting. It's a great way for firms to get to know how someone is as an investor, so to give them a checkbook. And the other, and this is sort of even more non-obvious, is I've seen firms put someone as a scout. Similar reason almost as why they put them as an EIR, which is to sort of gain their loyalty for when they look to start a company, that they'll think of that firm first. And one scout program I was a part of actually had a sort of allocation almost set aside for when anyone in the firm started a company, there would be a certain allocation so that they can raise their first money from that firm, which I thought was an interesting approach. Mm-hmm. But maybe one question we'll close off of is, as you sort of look out at the future of VC, and all of our firms are sort of thinking about that and making experiments on that. 5 years out, 10 years out, you think of sort of democratization of the asset class, which AngelList and Mingling, and we're trying to contribute to. You guys have pioneered. What else? What have we not talked about that you expect to see in terms of how angels play in the market, how they play in respect to LPs, how they play in respect to VC firms? What else do you think that we should discuss as it relates to the future of venture capital?
It's hard to know. I mean, I guess what I tend to believe is true is that we're seeing the further professionalization of the early stage. So we talk about angels, but really, how many angels do you know, right? If an angel is someone who's investing their own money and not really considering it a serious business effort, right? So I think scouts are part of the professionalization. It's professional capital trying to get access at the earlier stages. So I expect broadly we'll just see a continuation of that trend, and exactly how that plays out, whether that's, Village scaling to $1 billion fund, or, AngelList and sort of this more open economy, or, some third or fourth or fifth model. I don't know. I think actually probably it's just all of these things, because there's so much opportunity. There's so much growth in tech, like, for example, outside of the Bay Area. So that changes things in a material way that we haven't really talked about much at all. If you need scouts in San Francisco, imagine what you get, like what changes when the market gets bigger than 7 miles by 7 miles, right? So I think we'll see more experimentation, more diversity of models, much more professionalization, and the industry is growing. So hopefully all of these things can work.
Yeah, I think the two things I would hit on, one would just be the macroeconomic environment. I think it's on everyone's mind right now, and I don't think we have to deep dive into everyone's sort of anxiety around where the market's going to go, but I do think it's going to be interesting to see, is what we're seeing right now, is it temporal, meaning is it because we're in this frothy market and, when the market switches, it'll go away, or is it structural? I'm definitely in the camp that it's structural. I mean, I think, Parker probably is as well, given what we've seen at AngelList. I think it has legs and it's going to go well beyond, this cycle. But when the cycle switches, I do think we're going to see, who's really in it for the long haul. And, it's going to stress test some of people's thinking around it in the models. And I think it'll be overall positive and helpful, but, who knows? The second thing is, I think inside of all this, there's a question around specialization. And as technology obviously spreads into parts of our lives where it's never been before, goes into more regulated industries, gets more and more technical and scientific and difficult to understand, are we seeing the rise of the specialist? Is that what's inside of, these new models where people are going to build businesses investing around, very particular areas that do require high levels of context, domain expertise, networks that are able to identify and recruit talent and things like that, or is it, kind of business as usual on the venture side, which I'd say is more of like a generalist model. And to what degree, like, does it swing in either direction? I think that's something I'm excited about and thinking about on kind of the 10-year horizon, because if it is the case that the specialist kind of wins the day because technology is kind of moving into a new chapter around the specificity and understanding you need to succeed as an investor, I think the 2 and 20 kind of fund model is gonna be, tested in a lot of ways, especially at like the seed and Series A stages. Later stage investors, I think, really do a lot more of their work around financial engineering and are probably saved from that. But, jockeying for position early on and understanding these markets, it doesn't take long in sitting at AngelList to understand that it's like, I'm above my skis in a large percentage of the stuff that I'm looking at. And I want to partner with someone who is, more of a domain expert and better at seeing that space than I am, because there's just only so many hours in the day and only so much you can know. But technology is going into so many spaces. And I think that's going to be exciting to observe, in the end of the 2020s.
Totally. Any thoughts on algorithmic investing in the future as it relates to venture capital?
I guess my opinion on that is the data early is very messy. Pre-product market fit, it's not obvious to me that the data tells you that much. And there may be ways in which it tells you the wrong thing, like let's go invest in people from Stanford CS because they have traditionally created returns. So it's not obvious to me that algorithmic works early. Later on, I think it's actually probably easier in theory to make it work, but then there's a question of how do you get access to the data, right? So if the data that matters is confidential data within the company, that's not necessarily that useful. And I think we've seen initiatives like Mattermark, which you're probably aware of, that sort of started with that premise, right? That we're going to go be a data vendor for the venture industry. And I think in the end, what they found is that they were able to figure out after things were working, like, oh, hey, these people are hiring a lot of people. That's a signal that this company must be doing well. Or, oh, hey, they're trending in the app store. That's pretty interesting, but that's actually too late. So the algorithms don't get you the data at the time you would need to make a decision. And then I think there's a question of, if you're using data at a stage where the problem isn't understanding the opportunity set, but getting access, then it's moot anyway, right? Because they're like, hey, I know the right things to invest in, but they don't want me on their board. They want that person over there. So I think there are strategies like correlation ventures that are taking this specific approach, and you'd have to talk to them about, what their challenges are and sort of how they manage those things. But I think, I don't know, maybe I'm just lack imagination. I tend to think data is going to be interesting, but not a game changer here.
100% agreed.
Yes. For a future podcast, equity investing in people before they start companies.
Oh, man. Terrible idea. We'll save it for another podcast, though.
Awesome. Thank you guys so much for coming to the podcast. It's been a great episode. Talk to you both soon.
Yeah, good to speak with you.
If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.